Ladies and gentlemen, welcome back to your regularly scheduled programming, about 14 minutes late if it does not say live in the bottom of your screen. Then unfortunately you are watching last night's live stream, and check back for the current live stream because we are now live in real time, baby. 10:14 p.m. Eastern Standard Time, ready to get it. We are experiencing one of the worst stock markets of your God-given lifetime. I don't know, man. I don't know. Stocks might bounce back tomorrow, though. They might. Futures are looking okay. I was going to say quite enticing, but they look decent. We were down over 0.5% not long ago. Now NASDAQ is up 0.36% in futures. Now, depending on what the Fed says tomorrow, whatever they say, they could say, yeah, we're nowhere near as tight as we need to be for monetary policy. And that would obviously be a very interesting situation. You said Aaron said he's waiting to pounce. I honestly didn't even get to really go through the whole earnings. So we'll go ahead and pull up the actual filing here, or we'll just read this. Okay. Because I don't want to go look at all these numbers right now, but we can here if I don't get enough info. After 80% plunge from peak, AMC stock bounces back slightly as revenue beats expectations. Theater chain produced $40 million more than expected in the first quarter in its 11th consecutive unprofitable period. Fuck you, analyst. You gotta throw that in the subtitle. We get it, okay? With summer movies ready to launch in coming months, AMC Entertainment Holdings produced a better first quarter than expected, and shares recovered slightly in late trading Monday after losing steam this year. AMC, down 9.01%, reported a first quarter loss of $337.4 million or 65 cents per share, the 11th consecutive quarterly loss for the theater chain after adjusting for a $135 million loss on a debt extinguishment and several other costs. The company reported a loss of 52 cents per share, an improvement from a loss of $1.42 a share in the same period a year ago. Revenue improved to $785.7 million from $148 million 1 year ago. Analysts on average expected an adjusted loss of 63 cents per share on sales of $743 million, according to FactSet. AMC shares gained about 2.6% in after-hours trading following the release of the results, after closing with an 8.7% decline at $12.56 per share. For theaters hoping to bounce back from the COVID-19 pandemic, this summer's slate of movies offer promise, but few arrived in theaters in the first quarter. The Walt Disney Company's decision to take Pixar Turning Red directly to its Disney Plus streaming service, instead giving it a theatrical window, playing into that dynamic, though the big movies that did hit theaters offered some hope. Quote, although overall box office revenues declined 44%, the lack of any meaningful new movie releases played a major role, as only 2 films cracked the $100 million mark compared to 5 films in Q4 2021 and 4 films in Q3 2021. B. Riley Securities analyst Eric Wold wrote in a review of theater earnings last month. However, we believe that more important metric is that box office for key new films, The Batman and Uncharted, exceeded expectations heading into their release, which highlights movie-going demand when the slate picks up this spring/summer. AMC Chief Executive Adam Aaron saw the positive in the first quarter box office performance, saying Monday in a statement the cumulative success of Spider-Man No Way Home, The Batman, Sonic the Hedgehog 2, and this past weekend's opening of Doctor Strange in the Multiverse of Madness should leave no doubt about the enduring appeal of theatrical exhibition. The outlook for the theatrical box office during the remainder of 2022 is very exciting, he said. AMC is ready to showcase compelling new releases, including Top Gun Maverick, Jurassic World Dominion, Lightyear, Thor, Love and Thunder, Minions, and Rise of Gru, Black Panther, Wonka Forever, and a host of other films. I can't believe what they left out the biggest movie of all time, the sequel, which granted it doesn't come out until December, but Avatar 2, dude. How do you leave that one out? That's gonna be the biggest film this year, I guarantee it. But it says in a conference call later Wednesday, Adam promised that pretty soon we'll be back to normal. Promised is a strong word. Quote, we get stronger and stronger as each day passes, and pretty soon we'll be back to normal, punching away as you would expect from number one player in the theatrical exhibition. Aram said, we're not where we want to be or need to be yet, but we now see it in our future. 2021 was a better year than 2020. 2022 will be a better year than 2021, and we already believe that given the expected movie slate, 2023 will be a better year than 2022. So, I guess that's a little bit of forward guidance, if you want to call it that. I'm not quite sure what you want to call it, but it looks pretty damn good. I mean, after all, they beat the estimates. But, dude, retail stocks got destroyed in after hours. What? Does anyone know what happened to retail stocks in after hours? Can, like, somebody let me in on that? Because I was not able to see what it was. But, like, all retail stocks got dumped. Sofi, down 8.38% here in after hours. Apple, go figure, it's up 0.40%. Look at, dude, like, my whole portfolio got dumped in after hours. Fubo actually didn't get dumped. Affirm was down like 11.12%. DraftKings, like, shit got dumped in after hours. It was bad. Upstart got smashed. That's what it was. Oh man, all these mods and no reply. Creamy goodness. Serious boys got something wild. Big Blue need a moment. We're listening. Thank you guys for tuning in, baby. Today was treacherous. Adam said he's been yeah. Cheese chaser need a minute. Okay, we got you, creamy goodness. We want to hear what you have on your mind. Very, very important. Win popcorn machine. Man, did he give an update to the popcorn business? Because I feel like they should have done that like a month ago. Bitcoin got clapped. I found something nuts and I can't present it without the computer. I don't know how to, present it then. If there's something, I'll pull it up. Manipulation at its finest. Oh, that's exactly what it is. Let's be real here. That's what this whole market is. It's pure. Well, not everyone would call it manipulation. I would certainly call it manipulation, right? Market makers are doing all of the trading right now. Like, there's very few people, in my personal opinion, besides people that are getting margin called right now, that are actually selling stock. I think the reason somebody would sell stock right now at a 13-month low is if they're getting margin called. And a lot of these stocks are at like 36-month lows. A lot of stocks are at their their COVID crash levels. I mean, DraftKings, that's a bad example. That wasn't even public then. But, I mean, look at this fucker. It's at $11. Who the hell is selling DraftKings here, right? Look at, what's a good example? PayPal. This is one just blows my mind. Just absolutely blows it. I just like, dude, you are well under your crash level. When the COVID crash happened, PayPal only hit a low of $82. We closed at $79.53 per share. Like, it's already bad. Like, nobody is selling PayPal right now unless they're getting margin called, and they have to sell it. That's it. Hope we don't see another day like this. Well, I got some good and bad news for you. We close under 400. We are in no man's land. Even with the move here in after hours, we're still under 400. So we closed under our key level. Now, the thing about it is, do we get good news? Do we get fundamental good news? If CPI is good and Fed speakers come out tomorrow, we have 5 Fed speakers tomorrow. It's going to dramatically move the markets by the time we wake up. Either up or down 1 or 2% is what I'm expecting from that, right? 5 Fed speakers. I believe 2 or 3 of them speak before the markets even open. And if they have good things to say, that's fundamentally positive for the markets, right? Meaning maybe the Fed says they're on course, or just if the Fed shows us a degree of competence, right? Like part and part why the market sold off the day after the Fed was because they ruled out a 75 basis point rate hike. At this point, market participants kind of want the Fed to do what they have to do so we can end the bullshit here. We can get back to normal, right? We don't want to have inflation 5% for 5 years. Do what you have to do. Give us a 1% rate hike if that's what you have to do. The markets did not like that Fed Jerome Powell took 50 basis points off the table. Now, granted, if the Fed comes out and says, yeah, we don't need to do that, monetary conditions have tightened enough, which everybody knows they have, then it's going to be a very bullish thing tomorrow. And then if CPI is good, it's also going to be a very bullish thing. And then the real test you have to think of, which, remember this throughout your whole investment journey, that would be like a fundamental positive greed type catalyst, right? It's not really greed in the sense of we've already fallen a lot, but it's a positive fundamental catalyst. But in order to sustain a rally in this market environment where everybody is fearful about growth, you have to see a couple things happen. You have to see inflation come down, right? If CPI is good, you'll probably see a 3 to 5% positive day. If it's really good, third straight month of declining core CPI, it's going to be beautiful for the markets. You're going to see green everywhere, and mix that with positive Fed comments tomorrow, and then obviously day after positive CPI. It's going to be green fields everywhere you can look. Look at the heat map. It's all going to be green. Now, the key is, if next report comes in bad, I mean, you're back to the same concerns. But the ultimate thing, besides all of that shit, is how do companies perform? That's why I'm honestly surprised that we have dropped 27% on the NASDAQ. I believe it's 27% now. Year to date. Let's go ahead and confirm these numbers. 16.65% on the S&P. NASDAQ year to date. Yeah, 26.59% since January 3rd, the first day of trading in 2022. This was very fast. Very, very fast. But bottom line, you need to see fundamental earnings really hold up. Now, I will tell you, the fact that Amazon is down 40% year to date, or, Tesla's down 30%, or Apple's down roughly that same amount, Microsoft roughly the same amount, right? And your other stocks that are down like 70, 80, 90%, they're already pricing in a lot of bad news. So it's not like, you've already gotten hit. Earnings are going to come in, if they come in like dramatically worse, this could be a different story. I don't expect earnings to be like 2021 levels of just funny money everywhere, people buying everything, right? Everybody bought iPads and iPod, just everything, right? I don't expect 2021 numbers, but the markets don't either. Obviously, look at what's going on with the price of the stocks. But if earnings can at least hold up, and you could see even a flat year for earnings, the markets are pricing that in. As long as earnings really don't dissolve, we can be fine. But until we see inflation really come down and continue to come down, and then the Fed acknowledge that and show some kind of competence, like they know what they're doing, even if they don't, it would mean a lot to the markets for the Fed to come out confidently and say, hey, we're not going to have a recession. It's not going to happen. I don't even care. Like Fed Jerome Powell came out and said, we believe there's a very good chance of getting a soft or a soft-ish landing. As soon as he said that, I was like, oh my God, he just literally said that we're probably going to get a recession. A soft-ish landing means recession. So if one or more of those things happen, preferably, inflation coming down, the Fed acting more confident, earnings holding up, then this could be the yearly low. If inflation does not come down, it's not the yearly low. If the Fed really has to go more aggressive, then 2 to 3 more 50 basis point rate hikes and go to, say, 3, 4, 5% on the federal funds rate, it's not the bottom. But you're pricing in a lot of bad news. Right. PayPal went from what? I'm muted. What are you talking about? I'm not muted. was gonna say, bro, if I was muted right now and you guys just let me ramble and ramble and ramble, oh my gosh. Oh my gosh. I'm clapped. No, you're good, Ricardo. You scared me there for a second. I'm like, man, that was a lot of value in a very short amount of time. Glad I'm not muted though. So that's definitely a good thing. But yeah, basically that's what you need to see the markets kind of find some footing. And believe it or not, people don't want to say this, but there is margin calls happening right now. Like, and if you guys are unaware as well, retail is probably starting to get margin calls today. Today was the single largest outflow of retail capital that you have ever seen in financial markets, because obviously we had a big influx of retail capital in 2020 and 2021. But today was the largest retail outflow day, or the largest retail selling day, which definitely surprised me. Start from the top. I got you, bro. Lou says to mute all relatives who don't. Man, oh my gosh. Dude, oh my god, that's crazy. I wouldn't say that. Mute all relatives who don't own AMC. That's like very extreme. Like, I don't think I have one relative that actively buys stocks, so like them owning AMC is like out of the question. These motherfuckers buy savings bonds, bro. My grandma actually asked me, she's like, so for my daughter, because she wanted her to like have something, you know, down the line, and she's like, what should I do? Should I buy savings bonds for her, or you know, give you the money and let you put it into some kind of investment for her, or some kind of fund? And I'm like, no to the savings bonds. I mean, I'm like, you could do that if you want to, but no, you can get like 3 to 5% relatively risk-free over the course of the next 10 to 18 years, and compound them dividends, baby. Let's go, young Beezy. Young Bizzle. SPY 360 by Thursday. Oh, that's aggressive. If I will tell you, if CPI is bad, like worse than expected, it's possible. It's not something I would bet a lot of chips on, but it's possible. So win Lucid. Man, would you rather buy a Lucid or a Lambo? That's kind of my issue with it. Lucid just said they were going to raise prices. I'm like, man, Lucid, I thought your prices were too high already. And you know, it's kind of crazy too. How many vehicles? Hold on, let me see this. Let me see. Let me answer the question first, and then I'm going to relate it back to Lucid. Oh, okay. See? Okay. So, I am yet to see a Lucid on the road, right? Follow me here. But I have seen a couple Rivian trucks. And I live in a gas state. We don't drive EVs. Like, you'll see a Tesla maybe once a week. Maybe once every like 2 weeks. Granted, Rivian has produced like double the amount of cars, but I have not this light shit again. I have not seen any Lucid vehicles yet. So, you know, it's just kind of hard for a pimp. I like Lucid. I own Lucid, but I don't know. They revised down their damn their projected deliveries by like 40% for 2022. I was very disappointed with that. Very, very disappointed. I did not see that one coming. Picked up 50 more AMC shares and 5 calls at 20 for next week. That could be a bet. That could be a good bet. Buying SPY puts at 300. You guys are aggressive. Like, this is honestly, like, this is not the time to be buying puts, or not buying a lot of puts. Why do I say that? Because we've already dropped 27% in the NASDAQ in 5 months. The odds of dropping another 27% are not that great. There's only been like we dropped like 70%, I believe, in the NASDAQ in I believe in like the 2000 bubble, but that was much different. Like, they were shell companies. There was no revenue, no business at half of them. People were just buying them because they had .com in the name. Now, granted, growth will slow down, all of that, we get it, but there is valuation support until there is not. That's why I'm saying at least you have to get next earnings season to really see like where is the valuation going to be, because the markets don't care, obviously, in the short term about what company's doing good or bad. AMD's down over 40% year to date, even though they have beat estimates every single earnings, and they have had A+ quarters every single earnings. The markets don't care in the short term, right? But when AMD's down 40%, the Nasdaq's down 20%, year to date, then it becomes very easy to say, hey, maybe we took this too far. And then even the slightest fundamental economic bullish news, and you see a major 3 to 5% rally, right? So you need to see fundamentals deteriorate, or at least be questionable even more. Like, people are not really expecting earnings to drop 20% in 2022, even though they very well possibly could. But the markets are not going to expect that until they have a reason to expect that, and you actually see some indications of that. Last earnings, they were too good. They were too good. Apple is fucking, much as I don't like to admit it, had great earnings, right? I think the company is way overvalued. I think they're a stagnant company. They got a lot of funny money in 2021, and they're not going to grow at the same rate that people expect them to. But hey, the earnings have not showed that yet. So I am probably very early, and that will probably come to fruition in 2022. But until that happens, people are not going to expect that. Wall Street kind of don't see things that we do. They kind of live in their own bubbles. They make millions a year. They don't understand these kind of things. If you're here, you're very resilient, beautiful ape. Yeah. If you're here, you are very resilient, that's for sure. Let me guess, AMC had another bad day, so this means MOS, and if it's ever a random good day, that means MOS. No, I do believe we're getting closer than not. I don't even know if I have to explain it, because I mean, you always come on here and you always give me the clown emoji, and I get it. You're free to do that. But if you've ever watched one video, then you would understand what I've been saying. So you obviously don't. Let me give you a brief rundown of this, because I personally like you. I personally do like you, Evergreens. You're well known in these live streams, and I do like you. So I'm gonna explain it to you. Why do you think shorts never covered in 2021? Why do you think the short interest only went down about 6 to 8% during June? Well, it's because you could call up your hedge fund buddy, you could call up a bank, you could call up the damn Federal Reserve itself, you could call up anyone, and they would lend you money for 3% because a bond paid you 0.5%. There was cheap capital everywhere. You're a dumbass to cover on a short position unless it was like 5% of your portfolio. At 10x, it turned into 50% of your portfolio, and there was no way out of it. Some hedge funds got destroyed because of that. Melvin Capital, great example. They probably have 5% of their fund in an AMC short position, and at 10x, then they lost 50% of their value. Roughly, right? Give or take. Well, that's the reason a lot of shorts did not cover. If they only had like a 0.3% allocation of their portfolio, like 1/3% allocation of their portfolio in an AMC short position, and the stock went up 10x, well, they lost 3% of their portfolio. If they also lost on other stocks, whatever, get a margin call, whatever the case is, 3%, it's not something that you would like take a big loss on. You're not going to like cover on that unless you had to. Everybody knows stocks go up and they come straight back down. Well, now the key difference is capital is very, very expensive. If you want to get a risky ass margin loan when the NASDAQ is down 27% in 5 months, who the hell is going to give you a loan less than 10, 15, 20% or more? It's not going to happen. Stocks are risky. Nobody wants to be involved with stocks, as you can see every single day. So that's the real pressure here. A hedge fund, they can't really go out and borrow money as cheap as they could before. Not even in the same realm. Like a year has changed a lot here. And then you get into the situation where it's like that snowball effect, right? The smaller shorts, they're eventually going to be the first ones to cover. And then the larger guys, they're going to try to stay in, whatever, do their thing. And eventually it works its way up. And you don't really have the choice to service a margin call or cover on your short position. You have to cover on the short position to oblige for the margin call, especially when you're looking at the bond market down more than the stock market. The bond market is destroyed. It's down 21% year to date. It's down 5% more than the S&P 500. And when you put up collateral, right? If you had a portfolio of bonds, all you had was bonds, right, that have lost 21% in the last 5 months, and you had a short position, and that's all you had. Let's just be extreme here. All you had was bonds and an AMC short position. Well, what do you think happens then? They say, hey, you got to put up some of your treasuries, X amount, or you're going to have to get out that short position because it just ballooned on you and, shit's hitting the fan, right? They take your principal amount. So they don't give a shit if you bought this bond at 170, 160, 150, 140, where a lot of bond investors did. Well, they say now it's worth $114.67 per share, but we're probably going to go ahead and discount that about 5 to 10% because bonds have been dropping every single week, basically, of this new year. So even on top of these prices, you're not getting a 1-to-1 ratio. Like, if you're going to put up a stock right now, they're going to discount that to your total margin amount that you have to put up. Like with the DTCC haircuts, right? They're discounting the value of your collateral because it is too risky and too volatile. They don't want a damn Lucid if it could fall to 10 as collateral. I had to pick on them. Or DraftKings, if it was $20 a week ago and now it's $10. They don't want that shit. They're not going to let you stay in your short position if you give them stocks that are dropping 10, 20% a week. No. That's the difference that we're looking at here. That's the true difference. And that is the difference between a margin call and a margin call turning into covering on a short position. Odds are it would be forcefully covered on a short position. A lot of these funds would probably not have a choice, right? Your stocks lost 20, 30, 40, 50, 60%. Now the banks want to discount that total amount by another 10 or 20% because that's what they expect them to drop still. That's the difference. So, very extreme answer there, but that's the way to look at it, Where's Rivian stock now? Everything random. Retail traders think it's going to 1,000. Never were. Where's Mullen? Where's all their rando stocks? I never liked Rivian from the start. I never liked Rivian. I think I made a video about not buying Rivian at like 140. It was stupid. Like, Rivian, that was a terrible example because Rivian was dog shit to start. I actually kind of like, you know, I don't personally like the trucks. I have not seen them. I haven't experienced it like that. The valuation was stupid, but I do see them on the road. So, like, there is a proof of concept that I am now seeing being bought. So, I mean, that's bullish right there. If you see a product people are actually buying and you see it in real life, it's usually a bullish sign. Because, like, if you're seeing it, probably other people are seeing it. That probably means the business is doing okay. We're going to get multiple stimulus again. It's SPY's going to test 500. Yeah, we are never getting stimulus for the rest of our life. Please, no more stimulus. Please. Jesus Christ. Oh my God. Please. I don't want any more stimulus. But Mullen was also dog shit. And I said that too. I literally said in the first video I ever talked about Mullen, I said this company is going to zero or it's going to 10x in value in the next couple of years. That's what I said. Like, that was my expectation, was either zero or it's going to 10x. And I put $350 into it. You know, so I try to be upfront with those things. So those two examples, Rivian I said was dog shit. Mullen I essentially said was dog shit. It was probably going to zero, but there was a chance that you could make a lot of money. And we were very early. I bought that at 70 cents. I cashed out with 100% profit selling covered calls at $5 for July. 100% profit on my position. Now I get to ride out Mullen shares, 500 shares for the rest of my life. If it goes to zero, fine, I made it free. If it 10x is in value, then I'll make 20 grand or some shit like that. That's the way you gotta look at this. Like, you gotta know what you're getting into. Like with AMC though, it's not a Mullen, it's not a Rivian. That's the difference here. We have to distinguish the differences between Mullen, fucking Rivian, or any of the Nano Dimensions or any of these other bullshit stocks we've seen. Like, AMC actually has a business behind it. That right now, it's hard to be bearish on travel and leisure activities. People are going out. They're going to see movies. They're going on vacation. The Disney parks have been packed. They've been raising prices for the last 6 months. Like, if any sector you want to be bullish on heading into summer, it's travel, leisure, and hospitality. But could be wrong. But there is at least like a worst case scenario with AMC that is not zero, right? Worst case scenario for Rivian, it's zero. Worst case scenario for Mullen, it's zero. AMC is not going to go to zero. People are not going to stop going to theaters. It's not going to happen. Like, you can't replicate a theater experience at your house even if you have a full home theater. You know. Gotta agree with Evergrande. They will turn printer back on. No, they're never going to turn the printer back on, ever. And when the Fed comes out and cuts rates, I am going to probably sell everything. So that'll be fun. That'll be very fun. When I did the AMC proxy vote, it showed my total share count. When everyone's vote is submitted, the total share count can be revealed, and it may show over the flow of 516 million shares. I'm sure. Day traders print eternally, just scalp fast 10% gains. Inflation and stagflation. Recession is literally, doesn't matter. You can literally always make a measly 10% scalp in any market. I mean, that's what I do. I scalp literally that. 10 to 50% any given day. 5 to 10 grand on it. Cut losses at like 1%. You know, basically just like that. Using technical indicators and overall market sentiment, news as well. Like if I know there's going to be a Fed speaker, like if I know Fed Bullard is speaking, then I'll feel a little bit more confident in like put position, right? Scalp put position, because I know when he speaks, the markets tend to drop, or when William speaks, or any other Fed members tend to speak, the markets tend to drop. At the same time, I know when Biden starts talking, to get the fuck out of your short position, because the markets always pump whenever Biden starts to speak, and then they sell off right after. So I agree. How many people voted Biden for stimulus? Probably no. You know what it was? Everybody voted Biden because they thought that he was going to get rid of student loan debt. And people found out the hard way that you cannot get rid of the government's largest asset. You guys know that, right? Student loans, government student loans, are the government's largest asset. They, like, it was self-explanatory, and I told people this when they were like, I'm going to vote for Biden because he's going to get rid of my student loans, and fine as dandy with having hopes and dreams, but it's the largest government asset we have, and we literally could not afford to do that, or the country would be bankrupt. Like, these even moratoriums cannot last that long. And what I will say is potentially refinancing on some of your student loan debt, if you guys have student loan debt, might not be a bad idea right now. And that's not financial advice. Do what you guys want to do. They might extend it a little bit longer, but with inflation this high, that would be something that would really help get inflation down, is more money being spent on servicing debt that the government owns. Does that make sense? At the same time, though, it is a midterm year, and usually returns during a midterm year are better than not. So we have that coming later in the year. Statistically, better returns during a midterm year. And also, maybe they don't start up the payments until maybe 2023 because of the midterm year, but early 2023, that's when payments will definitely start up again. But rates are not going to be, it's crazy to say, but rates are not going to be this low for probably a while. Oh, man, I need a beer. That's great. That's just great. Have they done anything correct, right? Have everything they've done, have absolutely the worst decision ever. They will turn it on for elections when we're devastated, basically. I won't get this without a super chat, damn it. Oh, hold on. Well, I definitely got you then, but you don't have to do that. I have not seen your message, though. Matt Donnelly, someone say Stimmy? Pelosi got America's finest assets. Woo. Yeah, Pelosi got destroyed. Destroyed. I'm using my AMC profits to sub to my principal's OnlyFans. Oh, bro. I actually don't blame you. I'm just playing. Make the economy go around. That's their greatest asset. Without voting reform, Democrats will continue to do it. And ballot harvest. Yeah, well, I've said this before, but one of my childhood best friends, he works for UPS, and he got a call at 4 a.m. Because remember, you were watching the screen, and Trump was winning by a large margin, and there was only a couple key states left. And then you woke up the next day, the voting was over, and Trump had lost, right? My buddy had literally called me up, and he usually just texts me. He called me up and said, "Isn't it illegal to move ballots around after midnight?" And I'm like, "Yeah, dude. You're not even supposed to move them at all after that voting day. But he had got a call at 4 in the morning to take a truck full of ballots to the counting center. But I think all politics are bullshit, to be honest. Like, they all have, there's issues with all of it. Ken Griffin. We love you, Ken Griffin. Need you to do a video call. Well, that's probably not going to be possible. Just give me the rundown, because I probably know what you're talking about, but I want to see if I'm correct. If it's safe to buy some long-dated spy calls, 400. Well, the issue with buying like spy calls here is what is going on in the markets, right? So the problem is growth concerns, growth fears. People are scared growth's going to slow down, which it likely will, but to what extent and how much has that already been discounted in the price of stocks? So the stock market is a forward-looking instrument. So if we expect growth to slow down, that's why we're getting beaten down right now. It has really nothing to do with the Fed raising rates. If growth was stable, the markets can handle the Fed raising rates. Like, that's not a recipe for disaster. Call it that, just the Fed raising rates. Mix that with growth slowing down, and technically we've never seen a scenario like this where we are raising rates this aggressively as growth is slowing down. Usually when growth would slow down was like way further into the tightening cycle than what we're seeing right now. So this is kind of unique in that form. Yeah. So, but ultimately the problem is if, like you got to think, how much has the markets discounted earnings? The Nasdaq's down 27%. A lot of stocks are down much more than that. So the stock market is obviously discounted a lot. So if the market's discounted a lot, but it actually comes in not that bad, that's where you could see a sharp V-shaped recovery, right? That everybody was talking about during COVID, the V-shaped recovery. Or the K-shaped recovery, as everybody was saying back then. If you guys have been in the markets for a long time, you probably got a laugh out of that one. But that's the thing. Did the markets overshoot and the fundamentals will come in better? Or is it fairly in line, right? If it's fairly in line, I mean, the markets could stay flat for a year, maybe two, right? 2018, 2019, I mean, you hit the high January 24, 2018, and then you did not hit a new sustained all-time high, really, like without periods of going under, right? Like if you draw a line here, horizontal line, like right there, hit the high, came down, you were all the way under the all-time high for about 6 months. You broke out all-time high. You were above your all-time high for about 2 months. You've crashed back down, and then you were under it for about 6 more months, and then you broke out again and headed towards a new all-time high, and then you came back down again, and then you broke out above, and then you kind of came back to the same neutral level. This is like a market where growth was pretty stable, right? Like GDP growing at like 1 to 1.5, 2, 3%, something like that. I don't remember the exact numbers during this time, but you know, the reason why the stock market did this was because nobody thought the fun would ever end, right? So that's the question. Is it discounted enough right now? I would say in particular names, like maybe PayPal, that's under its COVID crash level, or a Square or something. You know, PayPal's growing at 17% per year, or that's what they expect to grow at. That's much higher than the average stock in the S&P 500, which is about 7% growth. So a lot of your quality growth companies like a PayPal, like a Square, those are going to be the ones that actually start to catch bids when economic growth slows down. Investors, growth investors, they want growth, especially when it's hard to find. When there is only certain criteria of stocks that are actually growing at, say, 10 to 20%, and the economy is only now growing at 1%, or maybe it's not growing at all, maybe we're in a recession, that's where those 10 to 20% stable, strong growth companies will do very, very well. Not all the dog shit people bought, like my Fubo stock, might not do so well unless it keeps growing at like 100%, right? But by and large, growth slows down, recession, you do tend to see growth stocks actually outperform because of that reason. If you can't get growth organically in the overall economy, you'll pay for it in growth stocks, stable, strong growth stocks. So, yeah, long story short. But I would personally say a la carte's probably the best way to go right now, comparatively to the broad indexes. Because what's going on with the broad indexes, you're basically, by and large, like if you're buying a call on the broad indexes, you're buying a call on Apple, which has not fallen all too much relative to the all-time high. Like it is down quite a bit. But, I mean, has it really like retracted where its valuation should be, in my personal opinion? Probably not. Microsoft, very strong name in my personal opinion. Google, another very strong name. Tesla is sketchy, and those are stocks that you're buying a majority of. Amazon, also another sketchy business. So really the only ones that I kind of like out of it, broad-based, like an S&P SPY call, is like a Microsoft. So I would probably just go a la carte with like a Microsoft call or a PayPal call or a Square call. Those would be like my go-tos. Tesla, the only issue is their valuation is super, super high. If they do not hold up a 50 to 60% growth rate like Elon has projected and pretty much promised to investors, the stock will fall 50%. And it might take a long time to recover, just depending on how bad the consumer gets, what the demand looks like for Teslas, things like that. That's going to be the key to it. Tesla would not be at $1 trillion valuation if it was growing at 20 or 30%. That's like really good. Like 20, 30% is really, really good. That's high growth. 40, 50, 60%, like Elon projects, 50 to 60%, that's spectacular. Like, you don't find companies that are as stable as Tesla, as innovative, as much of the future as any other company is going to be, that is growing at 50 to 60%. You simply don't find that. So it's being rewarded with a very high multiple, like a 200 price to earnings ratio. It's like over 10 times more expensive per dollar of earnings than Apple. And the only difference is the growth rate. So if Tesla slows down, you get clapped. And, a lot of the companies potentially that could get clapped are probably a lot of your large tech stocks. So that's why I'm not really saying like I don't think we'll hit a new all-time high in the markets in 2022. Maybe not in 2023. Like, it's going to be very, very volatile. But odds are we're probably not going back to all-time highs even in the next year or two. Like, it's possible, but I think a lot of demand was pushed up in 2021, and it's going to be very, very hard for companies to beat out 2021 numbers. And until that happens, at your large 5 to 10 stocks that control the overall markets, you're not going to hit new all-time highs. That's why I do like to go a la carte here, and I like to buy the dog shit that has gotten beat down that could potentially be quality one day. Like DraftKings, they had stellar earnings. The stock dropped like 20% the next day. What else do I own? Polestar, I own Lucid. Those are more high risk, high reward kind of stocks, really innovative for the future. 5 to 10 to 20 year holds on those. It's not like a year trade. It's like a 5 to 10 year or longer trade. Abivai, right? They own Botox and Humira. Who's not gonna get their Botox? I know all the females out there can vouch for me here. When you start getting wrinkles, And shit, maybe I might get some Botox too. You're going to get that damn Botox. I want to be invested in that company, right? So I'm invested in that company. Snapchat, new generation. I'm going to bet on that for the next 5 to 10 years. Stuff like that. And hopefully you guys are catching my drift here. When it comes down to that, I think individual stocks will do better potentially than the overall benchmarks. Who knows? Who knows? But honestly, if I were in the camp of trying to just take a bet on some stocks that have gotten beaten down a lot, honestly, I would probably just go with ARK. Because everyone is so pessimistic on ARK. And those companies she holds are going to be the ones that really come back strong when the markets rally. You would think. I mean, things can not go as you expect, but that's what you'd think. Nasdaq is up about 0.80% currently for futures. So it looks like we might get a market bounce tomorrow. Doesn't look too stable. S&P only up about 0.5%. Dow up 0.36%. Stupid damn light. I love it. I love the light. Keeps going out. Did anyone ever tell you your voice sounds like James Franco? Is that the guy that's in the original Spider-Man? That one guy? Sofi, perhaps. Sofi, I own a lot of Sofi, and I'm down like 55% on it. And that's another one, like, you have to have a long-term outlook with Sofi. There's a decent chance Sofi does get bought out, considering its valuation, considering its innovation, and potentially disrupting a lot of larger players. There's a very high chance that Sofi will get bought out, sitting at a $5.46 billion market cap. So keep that in mind. That should be some level of, I guess, cushion. Like, if push comes to shove, somebody's probably going to buy out Sofi. But I believe they're expecting about $8 million of free cash flow this year. So supporting themselves, but not really making a bunch of money. The overall outlook looks pretty damn good. Insiders have been buying a lot of stock, right? Especially during this time period, in between like $8 and $10 back here. They bought a lot of stock. Bought a lot of stock. So there's a lot of good things going for SoFi, and I do like them for the long term, and I don't think new people to the financial markets or just banking in general are going to go with a traditional bank rather than a SoFi. Like, SoFi is doing a lot of huge initiatives here, right? They're giving you like they were like the first ones to give you like 2 to 3% when rates were at 0 on your money for your like savings accounts, right? They just got their bank charter, which means that essentially, like you hear, the banks will benefit from the Fed raising rates. Well, SoFi will also now be able to benefit from that as well. So there's a lot when it comes down to SoFi, but long story short, I do like it, but I don't expect anything too crazy. If anything, you could see a lot of stagnation in between $5 and $10 per share. Would not surprise me. And why I say that is because I don't know how much lending demand will actually be hit, and I don't know when student loans will actually get out of forbearance. I don't know when people will be forced to pay back student loans. That's when SoFi stock will boom, and that's probably when you want to be in SoFi stock. That's the largest segment of their business that has been shut down for the last 2 years, and they've still put up very impressive numbers. But when people have to pay back their student loans, and a lot of people, if they did have those adjustable rate student loans, their payments are going to shoot up through the roof, and the first thing they're going to want to do is refinance, and Sofi is going to be a main beneficiary of that. So there's a lot going on. It's really a long-term buy and hold kind of stock. Short interest is high, so there could be a decent short-term trade. When the markets do bounce back, it wouldn't surprise me to see Sofi bounce back 15-25% in a single day, because it's been so overly sold. It's got a 20% short interest, and it's a great company, all things considered. So yeah. All right, so ladies and gentlemen, that is going to be all. I think we rambled on long enough. I do appreciate every single one of you guys for tuning in and joining me here on this lovely evening. And futures are looking pretty damn good. Nasdaq up 0.77%, S&P up 0.43%, and the Dow Jones up 0.31%. So cannot argue with that all too much. You guys enjoy the rest of your night, hopefully. We get a green day tomorrow and get a little bit of a bounce. Don't get too jumpy, though. I will say that I wouldn't get too aggressive to the upside or the downside here until something fundamentally changes for the markets. You need to see inflation coming down. You need to see people really believing that. You need to see the Fed dial back on some of those hawkish comments. Something along those lines, a mixture of all of that. That's what you need to see for a sustained rally, or at least to find a market bottom until the situation either from there gets better or it gets worse, and then we'll have a totally different conversation here. But definitely not the time to be super aggressive swing trading either one direction with a high level of conviction. There's no conviction in this market. They will sell everything off tomorrow if they want to, or they will pop everything 5%. The markets could rally 5% tomorrow if the market makers wanted to. So that is it. Thank you guys. Love every single one of you guys. Cheese Chaser, Eric Cuddle, Ben Currington, Vlog, Jennifer Hendricks, God the Heavenly Father, Leo Longevity. Whew. Let's go, baby. And you guys just spammed it